welcome back to the show. This particular show is predominantly on P2P lending itself, wherein we'll keep on briefing about the product by default. In last 2 3 videos, we have actually compared P2P lending with the mutual fund, P2P lending with the bank, wherein a lot of interest been shown in those videos. Wherein going forward, we also going to go with much more in-depth product knowledge about the P2P lending. On top of it, in this particular video, we have briefed. We'll be going or we'll be digging into the product much more in detail with regards to the asset quality and how safe is the portfolio by in general, which we can hear from Mr. Amit More himself, who is the co-founder as well as the director in fencing. So keep watching. So let's dive into the session where we have discussed with Amit More himself. Hi Amit, as a continuation to our series on the enlightenment of the product with regards to P2P lending, let's discuss further about the risk profiling altogether. Welcome back to the show though.
Thank you so much, Uday. Thank you so much for hosting us. Yeah, so this is
Right.
kind of risk profiling is something important. Uday, I'm sure that you will be asked this question many a times, right?
Right, right, yes. So it is like, normally it comes from the clients and investors who are actually investing in the funds, or in case of the project itself, or in case of the P2P lending itself. So what happens is normally the questions do come out like how safe is the product, how safe is the asset class, how safe is the this thing, how is if I compare with a risk to reward, whether I'm equally rewarded for the risk which I'm taking. These are the questions which usually come from the client side. What do you feel about what do you think, how can we put it across to the client or the investor, and how do you feel the client can feel safe with investing in P2P lending?
Sure, Uday. I think there are many facets to this question, Uday.
Hmm.
We need to understand, first of all, that there is a higher return only where there is a higher risk. There is no free lunch, as we know in financial services.
Yep.
If you want to earn a risk-free rate, your best place is to go and invest in Government of India securities, which is as risky as it can get.
Right.
Anything else,
Hmm.
whether it's fixed deposits, whether it's a debt mutual fund, whether it's a duration fund, um, everything
Accrual.
an element of risk. Okay. Obviously, equity, whether it's small cap, large cap, mid cap, thematic mutual fund schemes, all have risk. They have done fairly well in the recent past, but we all know that the volatility and risk is part and parcel of it. You cannot um, isolate uh, the return from the risk, underlying risk involved.
Yes.
So, first of all, we need to be very clear about it that if we are making something which is over and above the risk free rate, there is definitely going to be risk involved into that product. Now, obviously, on the I'm not going to touch so much on the equity side, but on the debt side, there's various options for people, whether it's a State Bank of India fixed deposit or whether it's a liquid mutual fund, or a duration product or a rated NCD. You call whatever it, but there is always kind of wherever there is a return which is more than the risk-free rate, there is going to be a risk involved for us as well. In peer-to-peer lending, which is essentially a debt product, there is always going to be an element of risk. Um, what is important is how you kind of capture the risk, and whether your understanding of the risk is um, close to the reality or not, and how do you mitigate that risk. So these are the two important things that come to play on and see when you forecast that a corporate or an individual is going to pay a loan on time for the next 3 years or 2 years or 1 year. It is always a forecasting involved, and nobody can imagine something going wrong uh, with the individual's employment, with the macroeconomic situation. A lot of things are variables, so it's kind of a more of predictive science where you kind of predict in future. But um, there is a science to it. It is not kind of all over the place. There is a science to it, and there are various factors which determine the risk. Okay, so at Finzi, what we do, we take in those parameters. We have identified those parameters, and there are as many as 130 different parameters, Uday, where we analyze the customer and risk rate a customer, and then broadly categorize a customer into 15 different rating grades. Okay, A plus one, A plus two, A plus three are three rating grades which are very kind of safe customers, and A1, A2, A3, A4, A5, A6, and B1, B2, B3, B4, B5, B6, with B6 being the riskiest. So
So now you're saying the safest fund, which you said just now, which is A plus one, A plus two, right? So this is as compared to risk-free returns. What is the times of okay,
I'll come to that. So
right?
basically, once this risk rating happens, then we divide the into, because there are 15 ratings, we divide into five broad categories. We call it A plus, A alpha, A beta, B alpha, B beta, and I'll show you kind of something which is kind of there already on our website, where any investor can go and have a look at this document. Okay. Um, Uday, are you able to see a document that I have on the screen now? So this
Right,
is,
right. I have seen it.
any lender who is registered with us will be able to go and download this document. This is called a Finzi sample borrower profile, and it is kind of a detailed document which kind of gives some sense of risk involved, and what is the way that credit risk and the ratings work. And then it goes on to describe what are the different types of customers and takes example of that, what A plus looks like, what a alpha looks like. But I think let's focus on this particular screen over here. Um, and these are the five different broad rating groups that we have done, subgroups that we have done: A plus, A alpha, A beta, B alpha, B beta. So, Uday, answering your question, what is the kind of um, risk premium that somebody can expect, and what is the kind of risk involved? Um, Now, A plus has an average rate from 7.99 to 9.99. A alpha has rate from 10.99 to 12.99. A beta has 13.99 to 15.99, and 16.99 to 18.99, 19.99 to 21.99. B beta is the riskiest asset class. So let's say a customer who says that, hey, I want safe returns. Okay. The safest is A plus. Now, somebody who invests only in A plus will obviously not make too much of an alpha. Uh, but somebody who invests in A plus and A alpha, he will make approximately, say, around 11% PAPM return, which in IRR terms translates to around 12%. And if you take it net of Finzi fee and the write-offs that might happen, uh, a customer should be able to make around 10% IRR. Okay, with a plus and a alpha. When you throw in A beta into it, then the return would go up to 11.5% IRR. Okay, if you throw in a B beta into it, then the return would go up to something like a 12.5%, 13% IRR. Now, these are the returns which are kind of, which we have historically achieved. Now, let's say a mutual fund, debt mutual fund, or a duration mutual fund, or a savings bank fixed deposit, sorry, a bank fixed deposit, yields you on an average, say, 4 to 5%. Now, that 4 to 5% versus this 5 to 6% extra, whether it's worth the risk, that is the prime question that somebody needs to ask. And it's not about absolute numbers, it's also about multiple. That if you are earning 5% in one product, it is not about incremental 2%, but it is like you are earning 40% more than what you were earning earlier. So in our case, because if the return is, say, 11% in IRR terms, then 6% is the kind of extra return that somebody makes. Now, whether that 6% is worthy enough for somebody to take that risk is what we need to analyze. Um, as I was saying, there are two parts to it. One is how do you assess the risk, and second is how do you mitigate the risk. And Uday, the biggest tool that we have for risk.
If I could see here is like, here written here expected write-off, which is the bad debt. So that we can take as a risk, which they are taking to get a return of 12%. Can we put this across that way?
So it is
Yeah, not exactly, but yeah, we can match it like that, I think, right?
what
Maybe.
happens there, see, because this is not a collective investment scheme, this is one-to-one matching. Now, if that 1% return in A alpha comes only to you, and that is the only investment that you have done, then you technically can lose your entire capital, right? Because if there is 1 in 100 and you are unlucky enough to have that as only investment, then 1 in 100 would lead to kind of you losing the entire capital. So that is what I was explaining. For
That is the risk.
risk mitigation, okay, you have to bring in granularity, that instead of giving 5 lakh rupees to one guy, which is not allowed regulatorily, but give not do not give 50,000 also to 10 guys, give to 10,000 rupees to 50 guys, or give 5,000 rupees to 100 guys. That ways the averages will kind of help you, and then you will be able to realize that expected write-off, and you will see that you are making that return. So Finzi, the way it works in its algorithm, it forces a customer, it is not at his discretion. He can exercise discretion to go more granular, but Finzi forces a customer to kind of have a granular portfolio. That granularity kind of helps in risk mitigation. So risk assessment, risk mitigation, and then it is all about mapping my investment return expectation. If I'm expecting 10% return, then I can stay with A plus and A alpha rather than kind of going out to a B beta. If my expectation is 17%, 16%, then I might want to go to a B alpha, B beta, but the risk also comes along is higher. Okay. And what we have realized, and in recent past, we, for example, have not done a single B beta loan in last 3 months. Okay. So when things are tough, when we are going through a COVID, though we are recovering well, but we are going through the second wave of COVID, the idea is not to expose customers to the risky loans. So we have, from our point of view, from the platform strategy perspective, we also restrict customers who are high grade. So in a way, a customer can very, very clearly select what is the kind of return that he would want and what is the risk that he is willing to take. So that optionality is there with the customer.
Sure. So, so how do you like to sum it up, like with regards to the asset classes, and how do you feel as an investor who's looking at a decent return, where he should see investment? If you are been, if I am going to come to you and look for an investment which gives me some decent returns, what do you feel is the best option, or is it like mix of all asset classes, or is it like just pure A alpha or A plus is the best option for the client? What do you feel?
Now, this is also a function of time and what the platform is doing. Um, if I put myself into the shoes of any conservative investor, okay,
Mhm.
and I will kind of divide it into three, kind of a somebody who's kind of risk averse. I will restrict myself to A plus and A alpha with an expectation of around 10% IRR return for my portfolio. Okay. If I have an appetite to take more risk, and I'm a kind of moderately risk taker, then in that case I will plug in an A beta also. So A plus, A alpha, and A beta. And in that case, I should expect a return of around 11.25% in IRR terms across the three subgroups of the risk classification that we have. If I want a little more risk, if I'm aggressive, okay, then I will also select B alpha. B beta, anyways, as I said, that we are not doing too much, so it doesn't make sense at this point in time. But for the time being, a aggressive customer can select or should select all four. A moderately risk kind of risk averse person should select the first three, and a risk averse person or a conservative person should select the first two. So that is the way I would kind of recommend
Recommend.
people to create the portfolios.
Perfect. Yeah. So yeah. So basically what you're saying is if you are planning to take risk, be in top four rather than being last two,
But
right?
but another thing, Uday, uh,
Hmm.
don't select only B alpha, okay, or don't select only A beta and B alpha, because that is not the ideal portfolio. My recommendation will be mix of the first four categories from
Right.
A plus to B beta, rather than only B beta or B alpha or A beta.
So if we mix equally with all four, what is the IRR coming out to be?
That's what I said. For somebody like who invests in all four, should expect an IRR of around 12.25 to 12.5% IRR. Um, if somebody is only in first three, it should be 11 to 11.25%, and only the first two should be around 10% IRR.
Yeah, it's one amongst the exact answering which I was like looking for my some of the uh, client queries which we have been having actually.
Definitely, and it's all about what is the kind of portfolio you want to create, and
Right.
you can change the strategy, right? It might be that in this phase where we are not sure about the COVID phase three, we can
Mhm.
adopt a more conservative strategy. In 3 months, 6 months time, when we are out of the woods, when we are
Mhm.
sure that the country is well vaccinated, and we are, as WHO yesterday said, that we might be in towards endemic.
Mhm.
So if that is the case and there is a economic recovery, then at that point in time we can be a little more aggressive.
Right.
So it is
Right.
something that can change over a period of time.
Sure. So yeah, it was perfect. I think we are. I think let's close it at this only, so that let's not lengthen the video, so that clients should not bored about what we are discussing completely, right?
As by now you understood how assets have been distributed and been selected and how the risk profiling been done, we can take it forward to the next level wherein we can analyze furthermore in the next sessions. Whereas as of now, if you are looking to invest in P2P lending products, you just have to click the link which is mentioned in the description box, and you can also log into ecsmm.com specifically into P2P lending section, and you can start working towards investing into it. And in case if you need any help with regards to the investing, you can always send us a mail at support@ecsmm.com. Thank you for watching.